So before we tackle index investing and predicting returns, Mark Faber is not the only one calling for a recession. We had Sam Zell on our network a few weeks ago saying we might slip into a recession. What do you make of that?
Well, they may be right, of course. Nobody knows the future. I'm guessing that the economy will slow a little bit. It's been doing reasonably well. But I don't see large changes in, say, the growth of our gross domestic product, for example. We'll probably run about a 3% rate next year, and I don't think a recession is very likely. But investors have to understand that anything can happen in the economy and anything can happen in the markets in the course of a year. So it's better to bet on the long term.
Well, and I know that you are all about the long term, but Jack, just on that note, though, if you look at where, as Mark says, where treasuries are trading right now, and you look at the returns you've gotten, even if you were an index investor this year, you would have only gotten a 2% return. That does seem to signal that something's wrong here.
No, I don't think it's a signal that something wrong. We're just at a time where the general level of interest rates, of nominal interest rates, is very low. The general level of real interest rates after an inflation adjustment is actually not that much below historical norms. Okay.
Speaking about investing then, I know, and as I mentioned, you are clearly a long-term index investor. You recently wrote in a report 3 factors that help you predict returns, right? So you talk about looking at starting yield, earnings growth, and speculative returns. How did you come to this formula, and why do you say that that's a good predictor of returns on an asset?
Well, what you want to do is look at the source of the returns that come on stocks, in the case you're asking about. And the source of the return, I call it investment return, which is today's dividend yield, and add to that future earnings growth, whatever that may be, for the next 10 years. This is not a short-term thing. And with the dividend yield at 2% and possible earnings growth maybe at 5 or 6% in the next 10 years,
right,
we could have a return of, say, 6 to 7%. But then we have speculative return. And that's, Lord Keynes talked about this a good bit, and that is investors can change their ideas about the valuations of stocks. And right now, stocks are selling around 22 times earnings, and if they were to drop to, say, 17 or 18 times earnings, you'd take that 7% return down to as little as maybe 4% or less. So we don't know what's going to happen there, but there's a tendency for all these things to revert to the mean, is what we call it, Betty. If PEs are above average, they're apt to revert to the average over a period of time. We don't know what that period of time is. So I'd say modest returns in the next 10 years compared to what we've been historically accustomed to.
But what is the case for index investing, Jack? I mean, if you were an index investor this year, you would have gotten a very measly return.
Well, in a way, you're absolutely right. The index is up about around 2%, adjusting for dividends. But the average equity fund, the average actively managed equity funds, is down about 5%. That's a 7% gap in favor of the index fund. I mean, I don't know what people want more than that. And it's a little unnatural, Betty, because small cap and mid cap stocks have not performed as well as large cap stocks. So that's why the index is weighted heavily toward large cap stocks, has an inherent advantage. But it's just as good as the previous year,
right.
2014. The gap was just about the same as that. Only it was a 13 or 14% gain for stocks and a 7% gain for the average equity fund. And again, with small caps and mid caps not performing well. And another similarity between the 2 years is that international stocks have done very badly, off about 5% this year, off about 5% last year. So the index is the best alternative. No one likes to brag about relative performance, but the idea of investing is that the investor earns his or her share of whatever returns the markets are kind enough to deliver to us. Or mean enough, we should know this too, mean enough to take away from us.